Good afternoon. This is Arlan Suderman, Chief Commodities Economist with INTLFC Stone, and it's report day. So we're back to talk about USDA's crop report. We're getting into the spring of the year, but we're still focused on South America. That's the big story, and that was the story also as we went into this crop report. But first of all, and I need to be sure and hold this up here long enough so that I fulfill my obligation. And so once again, we want to make sure that we talk about the fact that price is a function of supply and demand, but is modified by the flow of money. And that has never been more true than what we've seen this week. We've seen that play out. One of the factors that I've been seeing, well, let me go into it a little bit and give a little bit of an explanation. First of all, you see here on the right-hand side of this chart that we have seen the dollar climb, and particularly we have seen the dollar climb since the elections. And it's not made the 14-year highs that it did on January 3rd. It's not got up to match that level yet. Excuse me. But it is rising once again because the expectation now has gone to virtually 100% in the marketplace that the Fed's going to raise the rates when it meets next week. The European Central Bank held their steady. They're still in stimulus mode. We are in a tightening mode. Japan will meet and announce what it's going to do the day after we do. The Fed announces on Wednesday of next week, and then Japan the next day. But overall, fundamentals for the dollar look strong, particularly if we get the tax and regulatory reform that's being pushed right now, if that's able to make it through Congress this year, and that spurs our economy as what is expected, then that would be very strong for our fundamentals at a time when many of the rest of the major economies of the world are still struggling. So that's bullish the dollar, and that tends to be negative for the commodities. Now, we've talked a lot about this in the past, and the fact that the commodities were hanging in there anyway, part of it was because of the crude oil market. And here I have the CRB index, which is one of the many commodity indices. When the funds want to buy commodities, they usually don't just go to each individual commodity, but they'll buy one of these indices, which is a basket of 17 to 25 commodities. Some of them are equally weighted among the commodities in them, and this one, the CRB, happens to be more heavily weighted toward the energy sector, about 40%. 39% of it is the energy sector, 23% of it is crude oil. And you can see here that on the right-hand side there of the chart, you see that we broke this trend line support that had been holding this market really for much of the past year plus. And we broke down, we first tested this. This is a weekly chart, so it doesn't show the day-to-day events, but started to break down day before yesterday, and then yesterday broke down in a big way, followed through selling today. Now, we may end up going sideways here. This does not mean that we're necessarily going to collapse in money flow to the commodities, but this does say that there's been a major shift in the paradigm, and the funds, which had been looking at the commodities favorably, are no longer doing that. Now, they still may not totally exit the commodities, and that's my bias at this point, but it does leave us vulnerable. So what we have to do here now is we have to see if this support, if I were to draw a line across these lows here from January, February of last year across, if that support holds. And if that holds, then we'll probably be moving in a sideways trading range rather than climbing higher. If that gives way, then it puts more pressure on the commodities as a whole. Now, this is a continuous commodity index. You can see that it did the same thing. This is one of the indices that is equally balanced between all the commodities. So it's been moving sideways. Crude oil had been holding up the major commodity indices for much of the last several months, keeping it from falling as the dollar went higher. That relationship started to weaken in recent days, and then today they well, actually this week, not today, but this week, that they both, crude oil and the major indices both kind of collapsed, and now trying to find areas of support. We saw West Texas Intermediate today close below $50, a significant break in that support. It had been mostly $51 to $54 for much of the past several months, and so it's broken now. Now they'll be trying to find an area of support and determine, are we going to go sideways in a different trend? Well, crude oil is out of that sideways range, but where will it find support? And will that allow these major commodity indices to find support? Or will the dollar keep going higher, resulting in the funds deciding to short the commodities? And that'll have a big impact on the grain and oilseeds. The grain and oilseeds can still rally in that environment, but they have to have a stronger story in order to do so. Makes them work a little harder to do so. I've seen it happen. It can happen. They just have to have a stronger story. Now, here's this graphic shows the shaded areas. Their net fund ownership of corn, soybeans, and Chicago and Kansas City wheat. This comes out every Friday. This data does from the CFTC, and it's as of the previous Tuesday. So this is already almost 10 days old. This data, you can see that we were building ownership in there, but now I think the next couple reports are going to show quite a reduction in fund ownership of corn, soybeans, and wheat. Looking at this morning's numbers, first of all, let's take a look. The corn crop coming in here at 37.5 million metric tons for Argentina. That's 1 million metric ton, roughly larger than the trade estimate. I was at 36. Soybeans, 55.5. It's about 0.3 of a metric ton above what the trade was expecting, 0.5 metric ton above where I was at on soybeans. I think it is justified, though, because we are in recent days here starting to see some tremendous yield potential in that area, and I do think it warrants going what USDA did today. As we look at Brazil's corn, 91.5 million metric tons, that's exactly where my submitted entry is. Now, you'll notice I have a 93.3 here, and that's because after I submitted that, then our Brazilian team revised their estimate up to 93.3. So we think that come the April report, we're going to see USDA push that estimate up some more. By then, we'll be starting to approach the pollination season. Commodity Weather Group thinking that the weather is going to stay fairly favorable through that period of time. We'll talk more about that later. But here again, that was considerably, almost 4 million metric ton above what the trade was expecting, and one reason that we saw the sell-off today. On soybeans, 108 million metric tons. That's up 4 million metric tons from last month for the agency. That is exactly what we submitted once again. So we nailed in our submission in the surveys to what USDA would do. However, since we submitted that estimate, Brazil has again revised their estimate upward to 109 million metric tons. And so here again, we're anticipating that come the April report, we will see USDA once again raise its estimate. Now, USDA come up with the ending stocks for corn, pretty much the same as where we were at last month here at 2.32 billion bushels. That's largely because USDA took 50 million bushels of demand away from feed usage, which was justified, and put it all into ethanol. That may be a little bit high on the ethanol side. We can hit that. I just think it's a little premature. But I think USDA was trying to keep that ending stocks estimate from going up. On the soybeans, we went up to 435 million bushels. Because of the large Brazilian crop, USDA cutting exports by 25 million, and then partially offsetting that with a 10 million increase in crush because of the strong soy meal exports that we've seen. Here again, I think that can be debated. I'm at 411 million bushels. It trades at 418 million. USDA has a strong track record of overstating ending stocks in its March estimate. In fact, it's done so in 17 of the last 21 years. So we'll see where that ends up. Wheat, USDA cutting imports by 10 million. resulting in ending stocks going down 10 million. I'm at 1.144 billion bushels, at least in my submitted trade estimate. I've updated that since, and we'll talk about that a little bit later in this presentation. Now, as we look at, where those wheat stocks are, you can see once again that soft red winter wheat were better than an 8-month supply. We've been seeing the hard red winter wheat stocks come down. They were at almost a 9-month supply at one point, but they're making their way down closer to a 7-month supply. I know it's still a big surplus, but it's heading in the right direction. Acreage is down significantly for next year. Drought is over 50% of the Plains hard red winter wheat area. We're about 3 weeks ahead of normal on the growth of that crop, maturity of that crop. That leaves us vulnerable for a spring freeze. Will we get it? We don't know, but it does leave us vulnerable. And that's one reason wheat prices are trying to hold on and not fall too much, and we're holding on to chart support. But overall, we've got the most relative to use soft red winter followed by hard red winter. Corn stocks, no change to the balance sheet other than the shift from one demand category to the other that I mentioned. We're still at 29-year highs on ending stocks, and so we've got a pretty good surplus there going into this coming growing season. When we look at where those world ending stocks are at, nearly half of them are in China, a little better than a fourth of them are in the United States. So there's about 3/4 of the surplus corn stocks in China and the United States. So what about the rest of this 25% of the world, the rest of the 25% surplus? It's spread out over many different countries around the world, and so therefore we really need to see what supplies in that part for the rest of the world. As we look at this, we're looking at about a 79-day supply here for world stocks overall. But if we take U.S. and China out of it, we're at about a 43-day supply now after this report. So relatively snug. We need to have a big crop out of South America if we're going to rebuild these supplies. It looks like we may have it, though. As we look at that South American crop, this is a graphic that Commodity Weather Group put out a couple of days back. I think it was on Monday of this week. And there's been some reports about how we're looking at below normal precipitation for the next 30 days for the region. Some people getting worried what the effect of that will be on the safrinha corn crop. But keep in mind this area generally gets around 10 inches of rain per month this time of year. Now that starts to ratchet down pretty quickly as we get into April into May. I think for April we're looking at 4 to 5 inches of rain normally. In the May we're looking at 2+ inches of rain, 2.5 inches of rain depending on where you're at. So going through the month of April at least, we tend to have a lot more rain than what we really need, assuming that we get good distribution. So if you look at the blue line here, that indicates what rainfall is expected to be over the next 30 days relative to normal. You can see it's below 100%. The red line is the minimum amount of rain required through the period for the crop. And so you can see that we're still going to be receiving quite a bit more rain for the crop than what it actually needs. And so we should keep yield potential high deep into the month of April and maybe even into the month of May. Most pollination really takes place in that last half of April and into May time period. Excuse me. As we look at this chart, again shows that we're looking at world demand, Chinese demand for soybeans, and you can see this parabolic curve here. This has been gap below it, and that's not uncommon for USDA, and then by the time we get to the end market year, it comes up, closes that gap, and we're right on or above the curve once again, and it looks like we're on that path. USDA again increasing demand for the current marketing year with some of the latest data out of China once again, and that means that imports increase as well. As we look at USDA's tendencies, we see that USDA has a strong tendency to understate exports in the March crop report. In other words, final exports tend to come in well above what USDA projects in March. And as a result, ending stocks, as I mentioned a little bit earlier, have come in below what USDA forecasted in the March report in 17 of the last 21 years. So let's look at the weather forecast. First of all, let's look at the North American spring outlook. This is from Commodity Weather Group. We see March forecast for precipitation on the and temperature on the left, April in the middle, and May on the right, covering the spring period. This is a much more favorable outlook than what we were looking at a month ago. We could see some wetness in the eastern Midwest, be a problem in April and May that may delay some planting and create some problems. But at this point, we're not looking for any major problems. You may recall that the previous outlook was calling for some significant cold and wet issues for the northwestern Midwest. Those have been basically taken out of the forecast. So overall, it looks like we're going to get the crop in. March looks to be warm overall. Now, you won't know that over in the coming days because we have a big cold wave coming through this weekend. But for the month as a whole, it should be warm enough to really get out, do some field work, and get things started. April and May looking more normal. Some cool temperatures in the northwestern Midwest, northern plains primarily in the month of April. And that shifts to the east and the Great Lakes area in the month of May, but no significant problems here. Overall, looking like a pretty good spring. Now, as we get beyond that, first of all, I want to focus on this graphic in the upper left-hand corner of your slide. This represents all the different models for sea surface temperatures in the equatorial Pacific that determine whether we have an El Nino weather pattern or a La Nina. Now, the expectation is that we're warming those sea surface temperatures. The zero line here would be normal temperatures in that region of the world and the equatorial Pacific. So when we move above it, they project above it. Here, this line here is the June, July, August level. You go right in the middle of that pack of those models, it would suggest a neutral, which neutral is anywhere between 0.5 degrees Celsius warm anomaly to 0.5 cool anomaly. Looks like we're going to be a neutral to warm El Nino. And in fact, the odds have been improving. This is from mid-February. You see, they only come out with this projection the middle of each month. Some of the latest data suggests that this will be warming up a little bit more, may even drive us into a moderate El Nino by the summertime. If we look at these early March projections down here, it shows basically that we still have about a 48% odds in that June, July, August period of a neutral pattern, but 47, almost 48% odds, almost the same odds of an El Nino pattern this summer. So overall, we can take a look then, and we will take a look at what the forecast should be for that. If we look at the readings then for overall for the summer and what the weather pattern should be, when you don't have a strong El Nino or a strong La Nina, then that leaves you more vulnerable to other factors really helping to influence the weather patterns in the Midwest. So in that type of a situation, what we look to next is this area right here off the Baja of California, sea surface temperatures, which you can see now are well above normal in temperatures. And that tends to favor a good growing season for the Midwest. And the forecast models right now suggest that they think it's going to stay warm. If that were to turn cool, then look out. That would be a hot, dry summer. But as long as this stays warm, then that favors a good summer for the Midwest. Probably the next influential area would be this area right up in here in the Gulf of Alaska, which has been below normal readings, a lot of cool pool in there. That is expected to moderate. If that does not moderate, then that tends to leave the northern plains, northwestern Midwest on the dry side. But it's expected to moderate. So these are areas that we're going to be keeping an eye on, especially that area off the Baja of California. This slide shows you the cool pool here in the Gulf of Alaska, and how when that holds in place, which three of the analog years it did, 69, 2001, and 2006, tends to give us dryness then in the plains and northwestern Midwest. So when you put it all together, and I like this commodity weather group puts it out and says, okay, how many of the analog years then under these conditions ended up hot and dry? Well, 25% of them, as we see here in the upper left-hand side of this graphic, 25%. That's up 3 points from last week's analysis. So about 25% odds of hot and dry in the Midwest. 32%, almost a 1 in 3 chance of dry but cool Midwest. So when you add these together, that's what, a 57% chance that will lean to the dry side overall. But look at this. That's a, what, 69% odds that we are on the cool side. So if we're dry but cool, that would tend to still favor good yield. When we look at hot and wet, just 8% odds. So overall, the odds would seem to suggest that we're probably going to be all right moisture-wise because we're probably going to be on the cool side, but we're watching that Baja, California area. So what does Commodity Weather Group think that we're going to do? Well, again, we see the June outlook on the left, the July in the middle, and August on the right. Precipitation on the top, temperature on the bottom. So it looks like June's going to be hot in the winter, hard red winter wheat belt and with central and southern plains, but mostly normal temperatures elsewhere. July really cools down, and that really tends to favor good yields. August gets even cooler relative to normal. Again, favoring good yields because overall precip expected to be very good. Maybe some areas are below normal, but those are areas where the temperatures are going to be cool. So again, Commodity Weather Group is expecting us to have trend or better yields and probably above trend yields from our corn and soybean crops. A couple other areas of the world that we're watching. And again, I want to thank Commodity Weather Group for this. I'm going to start off by showing their current forecast map. And we're most interested in Ukraine right here going into Russia. For the summer, which would be spring wheat, which is big, particularly in Russia, a little bit in Ukraine, but the corn and soybean crops there as well. So this is the March to May outlook here, and you can see good moisture is expected, but then in the summer they were expecting it to dry out. Well, look at the last 30 days in the upper left. It's been drying out. It hasn't been wet as expected. And so Commodity Weather Group went, looked at sea surface temperature anomalies, found cool temperatures up here off of Greenland and also off of West Africa. Everything else is above normal temperatures. They looked at the analog years for that type of scenario and found that it does favor dryness in much of Eastern Europe and particularly in Ukraine and into parts of Russia. So we'll have to watch to see if this holds. Don't have a great deal of confidence in this at this point. But this is a risk we'll have to watch as we go through the spring and into the summer. I also took a look at, this is the southern hemisphere, if that doesn't make sense. We see here South America. And this is for August in a moderate El Nino situation. I wanted to show you Australia. Look how dry it is. The wheat would be starting to move into its reproductive phase at this time. And look how dry it is. Australia has already called for a return to normal yields because they were just spectacular this last year, just like they were here in the United States for the crop they just harvested. So even with that, normal yields, they're calling for production to be about a third less than they were last year, last year's spectacular production. But if that dry forecast plays out, if they do get a moderate El Nino by August, then we could be looking at a much smaller crop even than that. So putting it all together, you've seen me give this display once again, but I've updated it. Focus here on the left. And I'm assuming a 170 bushel per acre trend yield on 90 million acres. That would be down from 94 million acres last year. And so that combination would give us ending stocks of 2.044 billion bushels, a marketing year average cash price of $3.45. Now, in the middle, what I do is I assume basically a repeat of this last year's yield and 92 million acres, saying we only shift 2 million acres, and you can see that we end up with ending stocks very similar to this year, marketing year average cash price at 3.25. On the right-hand side, 165 bushel yield, which really wouldn't take that much stress to pull us down to that level, and 88.3 million acres. Why 88.3? Because that's what our client survey showed in the month of February. That's not our forecast. Right now I'm sticking with the 90 million acres, and for the simple reason that this is our first year of that planning intention survey, so we don't know how much confidence to put in it. I'd like to have a little bit higher sampling rate, so I appreciate all of you clients out there who fill that survey out, fill it out every 2 months when we do it. I encourage more of you to do so. But look what the end result is of hitting that 88.3 and 165 bushel yield. We get a 1.1 ending stocks, and we just about have to ration demand with higher prices to do that. And so it pulls the marketing year average cash price all the way up to $5.35 per bushel with all the fund money coming in. So that's kind of the parameters. Here again, this is what I'm expecting, and this creates a bearish and a bullish scenario that are within the realm of reasonableness to kind of guide you in your risk management assessment and developing your risk management plan. Now on the soybean side, on the first estimate, I use our survey estimate of 87.8 million acres with a trend yield of 47.5 million. And look what happens to ending stocks, 288 million. Now, this is because of the strong global demand. And I have to be honest with you, I ended up very conservative in what I thought China would end up for demand. We are seeing a slowing of pork production in China because of pollution control regulations. But they also do have the opportunity to add a lot more protein to their rations to get up to U.S. levels. And so trying to time how quickly they will do that is a challenge. But as I look at the demand, and I have a fairly conservative demand estimate in here for China, but it still draws us down, even with that big acreage increase of 4.4 million acres. So bottom line here, demand is so strong, we've got to see that increase in acres even with the big South American crop. Now, here again, as we look at the middle scenario, 90 million acres. Very possible, I can't rule it out, and a repeat of last year's yield would give us ending stocks with a 7 on it. And I don't think too many producers want to see that. I think a lot of end users would like to. Now, let's say maybe we don't get the increase and we only go up about 3.5 million acres to 87 million, and we pull back the yield about 5% to 45 bushels per acre. All of a sudden, we're looking at ending stocks of 186 million bushels, and that's if I ration demand with higher prices. So here again, that kind of outlines the scenario, and really, I was frankly surprised, even with the big production in South America, just how many acres we need to have to maintain stocks at current levels. Now, as we look at wheat, don't have any fancy charts. We'll try death by PowerPoint here instead. And my old crop ending stocks estimate, very similar to USDA, about 10 million higher. Then I plug in a reduction in acreage this year, and give me to around 45.8 million acres, a trend yield of 47.5. Gives me ending stocks of 875 million. So that's down considerably from 1.139 billion in the current year. On the other hand, if we get a bearish scenario, we get a little bit more acres going into ground this spring and a higher yield, we end up with ending stocks very similar to this year. A bull market, we end up cutting those stocks basically in half, 632 million bushels that we see overall. So this kind of, again, frames the likely scenario there, as well as a bearish and bullish scenario. There's nothing bullish overall in this number, but the funds right now continue to see maybe the worst is behind us for the wheat. I'm not sure that that's totally determined, but this would seem to suggest that there's a good chance of that at this point. So wrapping it all up, today's report came at a time when the funds are selling the broader commodity sector. The report gave nothing to the bulls to counter that flow today. It gave no fodder, didn't throw anything at them to go against the grain of selling in the broader sector. They can still rally should a problem develop. It just has to be a little bit stronger story. Wheat is in a season of potential weather threats, so that's what we'll keep an eye on. Corn and soybeans have little fodder for the bulls today until or unless a legitimate weather threat emerges down the road. Soybean charts are probably most at risk at this point of breaking lower. We're going to have to watch them. Working in their favor is the fact that fund managers love trading soybeans, and so they're looking for excuses to buy it, but they're running out of reasons to support prices. Next up is USDA's March 31 report, and that has more potential for surprises. You've seen my analysis. I would invite you at this point to go to the upper right-hand corner, I believe it is, and participate in the question and answer session. We'll go and take a look at those questions and see what we can answer. So who will have the first question here coming up? Looking for the first question. Okay. Looking for questions. Okay. And let me get to my point where I can actually see your questions. Bear with me, please. We just changed the format here, and so I'm having a little difficulty finding where I see your questions. So please, I see that there's some questions coming in, but I just can't see them yet. So that's what we're trying to get to.
Hey, Arlan, this is Jake. I can go ahead and read you the questions. How about that?
That'd be good.
All right. What portion, roughly, of the China corn stocks are low quality that we don't even need to consider?
Okay, so what portion of the China corn stocks are low quality? That's the big mystery because China doesn't revealing. And that's an excellent question. I wish I had an excellent answer for you. It's generally believed that the majority of that corn is of lower quality. Now, lower quality so that it's totally unusable, we don't know that. China has been taking steps to try to facilitate growth in its ethanol industry, believing, it appears, that much of that lower quality corn can be used by the ethanol industry. Now, they may not like to use it, but China's trying to push it in that direction. And so that's one reason why we believe that they've been taking steps to limit our DDGs coming into the country so they can try to improve their ethanol margins, trying to do things to cheapen the corn for the ethanol industry. They did send a small cargo to Japan when we were having difficulties getting corn up to the Pacific Northwest to ship to Japan. Some of those problems are now starting to clear themselves up. But, you know, getting one cargo, it's not hard to get one small cargo of higher quality corn. Question is, beyond that, do they have enough corn that they could export or that'll meet the demands of the industry? That is one reason that we still are seeing some grain, sorghum, and corn go into China to be blended with what's coming out of their reserves. But it's still a huge mystery. There's a lot of speculation that the majority is lower quality. We just don't know how poor quality. I'm sure it's all across the spectrum, but to what extent. So appreciate that, Jake. What's the next question, Jake, as you read the questions to me?
Next question comes from Ed. Do you see an overall drop in soybean prices this summer as South America, heavy supplies, and large U.S. carryover converge on the China market?
I do not see China slowing down. Now, this has been a big debate on Chinese demand, and I have been bullish Chinese demand for years, and I continue to be. The one caveat to that is because of pollution controls, it significantly slowed the speed at which China can expand pork production. In fact, we've actually seen a contraction of pork production because they can no longer have pork production, so to speak, their new pork farms near cities or near streams, rivers. So that is really limiting their production capability, meaning that, and we saw this come out in a report from USDA yesterday on China, that exports, they're going to be much more dependent on importing pork, which is good for us once again as well. But they also have significant opportunity to increase the amount of protein that they use in their ration in order to become more efficient with the production they have. In other words, more pounds of pork per pound of feed consumed. And so that's why I have not seen a slowdown. Now, I know there's always a lot of emphasis in the trade talking about crush margins in China. Sometimes they're good, sometimes they're bad. But frankly, the correlation between Chinese soybean imports and crush margins is really poor. The crush margin can be poor, and they can still hit record imports. And they just kind of build up supplies for times when they're not. So overall, I continue to be very optimistic and upbeat about what we're going to see in the way in demand. I might mention, Jake, that I found the question, so thank you for reading them to me to this point, but I think I can take it from here. Do you see an overall, okay, that one I'm seeing, will the decrease in bean exports change the attitude of USDA over estimating ending stocks? You would think USDA would learn, they don't. USDA did cut their export target by 25 million today on the expectation that big Brazilian crop is going to eat into it, and logically that would seem to make sense. That I think instead what we're going to see is China's demand estimate increase. We are roughly 100 to 110 million bushels above the seasonal pace it needed to hit USDA's target. That does not mean, and that's the old target, excuse me, I haven't recalculated it with the new target as I was getting ready here. That does not mean that we're going to see final exports exceed USDA's target by that current target by that amount. But I think it's very reasonable that we could see it exceed it by 35 to 40 million bushels. That'll be the big debate. Again, as I showed you earlier, USDA seems to be very poor at may I should say, very good at underestimating exports, and large because they underestimate Chinese demand and therefore overstate ending stocks in this March report. What happened to the soybean corn price ratio on April 30th, 1996 and June 30th, 1996? Whoa, you're going to tax my memory on that. June 30th, 1996, I can almost guarantee you that was a surprise in the acreage and stocks report. The April 30th, 1996, I'll have to go back and look at that one. Perhaps I can do so and have something for you at a future date. But April 30th, 1996, my memory is not that good on what happened on that date. In the future, can you have a calendar event that downloads to one's computer and one signs up with a reminder turned on? We'll look into that and see if that's a possibility. It's certainly a good question there. What happened? I read that one. Arlan, considering the dryness on the plains and the weak cash prices in wheat, what are you figuring on abandonment for the winter wheat crop? That's another excellent question. And hello, Tanner, by the way. Appreciate the question. When we look at the dryness, I'm hearing of quite a few farmers in the southern part of Kansas looking at abandoning wheat and going in with cotton. Cotton really works well in southern Kansas and into Oklahoma and Texas in the crop budget. Surprisingly so, not everybody's going to have access to a gin or to the equipment, so it's not going to be a widespread shift. A lot of row crops going in, probably going to be soybeans where there's moisture and where there's not, grain sorghum. But typically in that area of the country, we'd be looking at maybe well, for the hard red winter wheat crop, we'd be looking at abandonment in that 10% area, maybe 9 to 10%. Maybe even into the 15% range, and this year I think we'll probably see that stretch toward 18 to 20%. So a lot of it depends on when we get moisture, even this weekend, how much moisture. Right now the forecast is not very much, but frankly with the dry winds we've had, I think we're going to see these weekly crop ratings. Yeah, nationally we don't get crop ratings on a weekly basis until next month. But in Kansas, we should see them weekly now, and I think we're going to start seeing these crop ratings start to turn south in a hurry and start to provide some concerns. Any expectations for inflation? Well, when we look at the five-year projection, which I've showed you this chart before, it's really showing expectations in that 2 to 2.2% range. I think that's very reasonable at this point to expect that. So I'll go with what the market is saying there. I think that's a reasonable expectation. If the sell-off on soybeans continues, where do you see the next level of support coming from when looking at the charts? Unfortunately, I don't have a chart here with me, but we were very close to in a sell-off today, some areas of chart support, and so we'll see how that holds. I think the bigger question is whether the major commodity indices, including crude oil, continue to sell off, and if that does, it may not matter where the chart support is, but frankly, I don't think the funds want to just totally give up on soybeans. So as I look at the soybean market overall, you look at areas of chart psychological support in the $10 level, down to the $9.50 level. I do not see it dropping below the $9.50 level until we get a better handle on the growing season ahead for the United States. So typically, we would start building some risk premium in for our U.S. growing season this spring. We still need the acreage. As I showed you, I had a big increase in acreage built into my tables, and we still saw stocks go down. And so we need to make sure we keep that soybean corn price ratio up there toward 2.7 to 1. Excuse me. What is the weather outlook for April? And to a great extent, I showed you that. Maybe some wetness in the eastern Midwest. warm overall for March, but April looks like closer to normal. Maybe some coolness up in the Dakotas and surrounding areas. Maybe some wetness in the eastern Midwest, but otherwise I think we're looking good. Is there a tendency for corn acres to increase if it is relatively dry? Absolutely. As a professor told me, I hate to admit this, nearly 40 years ago, every farmer likes to grow corn. The only ones who don't are the ones who can't because of soil and or climate, and I would add to that and or the banker. So a lot of it depends on price. Today's price break, yesterday's price break certainly don't help that matter. We were seeing with the move of December corn above $4, that was making it easier to ignore the banker. Now the break's making it harder again. We have not broken chart support for corn like we, to the extent we have soybeans. But whether we'll be able to hold that support is a big question, and that may be difficult if we continue to sell off the major commodity indices. Okay, where do you see interest rates in the next 1 to 2 years? Also the stock market. That's going to hinge really on Donald Trump and the Congress and how successful they are bringing about tax and regulatory reform. If we get that tax and regulatory reform passed, I think we see a spurt of growth in this economy that will be strong. And after that spurt of growth, I mean, maybe 2-3 quarters in a row, maybe a little bit more, but at some point then with those interest rates going up, you put a big burden on our national debt. And with every 1 percentage point that interest rates go up, we're talking about another $200 billion a year just to service the interest on that debt. Interest is already 7% of our national federal budget, and that's going to increase dramatically as interest rates go up. So that's a real problem. So I see a time of strong growth if we get tax and regulatory reform, followed by some real concerns about the sustainability of that growth as interest debt starts to squeeze the market, and we have to start figuring out how we're going to pay for that. And the stocks, I think, follow that same notion. Stocks grow with the economy, but then as we start running into problems after we've repatriated money from corporate profits from overseas, then where does the growth come from, particularly if the dollar is strong and interest expenses are going up? Is Mexico's threat to shift corn imports, I assume means, is it legitimate? Oh, I think the threat is legitimate. I think a lot of it is positioning. The bottom line is they can't afford to import corn in the current scenario. But if Brazil produces a big crop, which drives Brazilian prices down, that makes them more appealing, and Mexico can afford to pay the price, which means that U.S. prices then have to try to go down in order to keep the business. So all the way around, that is bearish for corn prices. Excuse me, if the Brazilian safrinha corn crop, excuse me, if the safrinha corn crop is a big one. So I have 2 questions there, which are basically identical. Any concerns that avian flu could cause further issues for poultry industry, impact on feed demand? We certainly saw that play out 2 years ago. Whether we're going to have a repeat of that this year or not is the question. Oftentimes we're able to get control of it. Certainly something that's concerned, and we're watching closely. We do not want to see a repeat of what we saw 2 years ago. If so, then that would be expected to be positive for pork and help for expansion of the pork industry taking market share from poultry. So it's not just as poultry are killed in order to try to control the disease, we see an equal feed demand drop. That's not necessarily the case. In other words, it's not a one-to-one relationship. In regards to the corn-soybean planted acreage, don't you believe that any added soybean acreage will come from the fringes of the Corn Belt as opposed to the more productive acres in the big corn-producing states? Boy, we're getting some good questions in here. That was, Ron, that was my thinking all along until I started looking through in the details of the data from our client survey. And that client survey, which we followed up doing some anecdotal work and some more budgeting work, etc., would suggest that we do have some areas of the Midwest where the bankers are putting on more pressure onto the producers, that we could see more of a shift than expected. Now, Iowa is one of those places we expected to be most stable. Everyone said they're going to stick with the rotation. But we have seen some anecdotal evidence that the bankers are putting some pressure on to make the shift. Now, Iowa's one place that could afford to give up some corn acres because they still have quite a bit more corn than they do soybeans when you look at the ratio of planted acres to get into a better rotation. So this is a year we're going to go into that March 31 report, I think, with some bigger question marks on what in reality is happening. I can give you anecdotal evidence that we're not going to see that big of a shift, or I can give you anecdotal evidence that we're going to see a much bigger shift than expected. Right now, I'm sticking with the 90 million acres of corn, probably something closer to 88 million acres of soybeans, although that one would be easier to see up to closer to 90 million. Eduardo, is planting soy on soy a possibility, as is planting corn on corn? Yes, it is. Of course, much of that is done in Brazil, but the U.S. farmer simply likes growing corn. Overall, historically, he's gotten a better return from the corn. We've seen a bigger rise in yield potential, more consistent yields, fewer disease problems, so he's done better. Now, the budget would certainly seem to appeal to more soybeans, and we certainly could go from an agronomic standpoint towards soybeans on soybeans, but the American farmer simply loves planting corn too much, and that tends in the end to be the dominant factor. So that's all the questions I have at this point, and I see that we've gone a little bit longer than normal, and I'm starting to lose my voice. So I appreciate everybody being a part of things today, and we look forward to being back with you on March 31 when we have that big stocks and acreage report. Thank you.